The stock market just took a hit after President Donald Trump announced a new 15% global tariff rate, and this came only days after the Supreme Court limited his previous tariff authority. The Dow dropped more than 800 points in one session. So the big question is this the start of a bigger correction or a new buying opportunity? On February 20th, 2026, the U.S. Supreme Court ruled 6-3 in Learning Resources Incorporated v. Trump, blocking Trump from using emergency powers under the International Emergency Economic Powers Act, or IEPA, to impose sweeping reciprocal tariffs. Almost immediately, the administration pivoted. Instead of IEPA, Trump invoked Section 122 of the Trade Act in 1974 and announced a 15% global tariff rate. Markets reacted quickly. On February 23, 2026, the Dow Jones Industrial Average fell 822 points, or 1.7%, closing at 48,804. The S&P 500 dropped 1%, and the Nasdaq Composite declined 1.1%, led by heavy losses in tech and cloud software stocks. Investors are clearly concerned about renewed trade uncertainty. Under the previous emergency authority, tariffs were broad and open-ended. Now, under Section 122, tariffs are capped at 15% and limited to 150 days unless Congress extend them. In addition, the government may have to refund more than $130 billion in previously collected duties. So while the market reacted negatively, this new framework is actually more structured and legally limited compared to the earlier approach. However, it also created a policy deadline in mid-2026 when these tariffs will expire if Congress does not act. Certain sectors were hit especially hard. In software and AI, stocks like Datadog, CrowdStrike, and IBM saw sharp declines as investors worried about both trade costs and broader AI-related uncertainty. Automakers and consumer goods companies face immediate cost pressures from higher import costs. However, companies that previously paid high tariffs could benefit if refunds are issued. Economists estimate the new tariff regime could reduce long-run U.S. GDP by around 0.2% and increase average household costs by roughly $400 in 2026. That's not catastrophic, but it does add economic friction. There is also the possibility of retaliation. Other countries could respond with tariffs targeting U.S. agriculture, automobiles, or industrial exports, which would pressure multinational companies. At the same time, for some countries that previously faced much higher tariff rates, a flat 15% rate may actually represent a reduction that could eventually stabilize certain trade flows once uncertainty settles. So, could this be a buying opportunity? Historically, markets often overreact to trade headlines and recover once policy becomes clearer. If volatility continues but earnings remain strong, selective opportunities may emerge. Some consumer and retail names that were heavily impacted by previous tariffs include Nike, Amazon, Target, and Lululemon. More domestically focused sectors, such as utilities and certain banks, may be more insulated from global trade disruptions. Companies like Vistra Corp and Wells Fargo are often viewed as relatively defensive in this environment. Meanwhile, domestic industrial producers, such as Nucor and logistics firms like Old Dominion Freight Line, could benefit from protectionist trade policies. In the short term, volatility is likely to continue. In the medium term, the legal clarity from the Supreme Court ruling may actually reduce extreme policy risk compared to the previous open-ended tariff framework. Ultimately, markets will continue to focus on earnings growth, economic data, and how Congress handles the 150-day tariff window. Thank you so much for watching. If you found this video helpful, please like and subscribe to the channel. It really helps support the content, and I'll see you in the next video.